Level up!
Hello YouTube, welcome back to Level Up Trading. It's been 3 weeks since the last stimulus challenge update, so I wanted to check in and share what's been going on. To recap, I received the second round stimulus of $600 and I decided to put it all in my Robinhood account, split 50-50 between the ticker SPY and my own stock picks to see if I could beat the S&P 500. Additionally, I'm treating my account like a video game, using only very basic strategies at first and introducing more advanced strategies as I gain experience trading, just like a character in a video game. Right now, the only strategy I have available to use is to simply buy and sell a stock, and until this week, all I had done was buy 3 stocks: Amazon, Microsoft, and Apple. Because I only had $300 to pick my stocks, I only bought $100 worth of each, which meant I had to buy fractional shares, so I didn't really buy a whole share of any of these stocks. Regardless, I felt that these tech company stocks would outperform the S&P 500, which they did with ease. This is a pretty expected outcome because the S&P 500 is an index fund. The index fund, some might say, because it represents the 500 biggest companies in the US over many sectors of business. The point of the S&P 500 is to provide investors a way to invest in the total stock market without having to create their own portfolio by picking individual companies to invest in. I was going to summarize where the S&P originated from, but it should be its own video and it's not necessarily the content I meant for this video, so maybe I'll do that in the future. What you should know is that the S&P essentially provides investors a way to invest in the US stock market as a whole without having to buy and sell individual stocks to keep up with how the economy's doing. Here's where it gets a little bit confusing. We're not actually trading shares of the S&P 500, which is managed by Standard & Poor's and is an index or tracker. The SPY, however, is a fund with actual shares and has a trustee who manages it, and I believe that trustee is State Street Bank and Trust Company. Their fund's shares are tradable equities just like any other stock. Other companies also create funds that track the S&P 500 index, but are not the exact same as the SPY. For example, my company's 401k has a S&P 500 fund available called Fidelity 500 Index Fund, which lets us invest our retirement contributions in the S&P 500. This fund is obviously managed by Fidelity and performs like the S&P 500 index. So that covers the basics of what the S&P 500 is. So why do I care so much about beating it? Well, the S&P is a really easy and passive way for investors to get a good return on their investment without too much risk. Historically, the S&P 500 has a 10% return on investment, and after accounting for a 3% inflation, we can conclude that the S&P 500 will likely give an investor about a 7% real return over a long period of time. I should note that the returns of the S&P 500 have been studied and debated forever, and these numbers are just my estimates based on the sources I used. As for risk, because the index includes 500 companies, the gains and losses are small over short periods. In order for the S&P 500 to crash, the whole US economy would have to crash, which has happened a few times, by the way. And when it has crashed, it has always recovered. But overall, the S&P 500 is typically immune from crazy single-day swings in gains or losses. There is one more important thing I should mention about the S&P 500. It is weighted by market cap, meaning the largest companies make up a bigger share of the index than smaller companies. 5 companies account for about the same volume of the S&P 500 as the bottom 280-something companies. Those companies are Apple, Amazon, Google's parent company Alphabet, Microsoft, and Facebook. The great performance over the last decade or so is largely because of these companies and a few others, and I believe without these companies, the index would have actually had losses. To sum all of this up, I want to beat the S&P 500 because it is the easiest and probably safest way to earn good returns in the stock market. If I can't beat it, then I should have just put my money in it to begin with. Now, the S&P 500 returns are somewhat modest, and lots of people do beat it, especially professional traders. Another thing to consider is, if I do beat it, was it worth my time or the risk I took? I could theoretically get a 7% return for doing nothing, so if I spend lots of time or took lots of risks, was it worth it to beat it? I have to keep these things in mind when making decisions. I think that covers what I wanted to concerning why I want to beat the S&P 500, so let's catch up with my account. The SPY began the year at $368.79, and at the time of this recording was at $378.41. Which is a gain of 2.61 year to date. That's super good for 30 days historically if we expect a 7 to 10% return by January 2022. Amazon began the year at $3,186.63, and at the time of this recording was at $3,285.80, which is a gain of 3.11% year to date. Microsoft began the year at $217.69, and at the time of this recording was at $236.47, which is a gain of 8.63% year to date, which is pretty crazy. Apple began the year at $129.41, and at the time of this recording was at $143.02, which is a gain of 10.52% year to date and is the best of my picks so far. I think the gains we've seen this year on my picks are not sustainable, so I'm going to take these profits and sell my shares for a pretty good gain. Then I'm going to reinvest my original amount plus the gains. The problem is deciding what to invest in. I want to find something that has maybe been down for a while but might recover in 2021. With all of the positive vaccine news, I might consider the travel industry. But the timeline for good news in this sector might be too long for a YouTube channel. I've also kept up with the news a bit and saw that President Biden is mandating all government vehicles be electric. That might be a good opportunity for the auto industry. I mulled over some of the options and decided to make a few moves. I do think part of the travel industry will recover this year, but some areas more than others. I think business travel will recover first, so I'm going to go with an airline for now, but not hotels and resorts just yet. I like Southwest as a company. I think it has a good amount of recovery room, and I don't think it's as risky as, say, American Airlines. So I'm going to buy 2 shares at $45.07. I also think the auto industry is looking good, but I'm going to extrapolate here a bit. I think in the long term, the US auto industry building electric vehicles will be good for them, but they aren't there yet. I think the US government changing over to EVs is good news for all EV companies, and I'm actually going to buy 2 shares of a Chinese electric car maker, NIO, at $58.33. I'm also going to make a speculative pick for the remainder of my account balance. I think we're going to see even more renewable energy initiatives in 2021, so I'm going to invest in a solar ETF ticker symbol TAN at $112.46. I'm happy with this update because, as anticipated, my tech stocks beat the S&P 500 by a fair bit, bringing my account balance to about $623 from $600, including the modest gain on the SPY. I also made 3 trades that met my buy low, sell high criteria for my level up project. Only 7 more trades to unlock my next strategy. Now that we're really underway with the stimulus challenge, I hope to level up quicker and use new strategies to grow my account balance. If you enjoyed this video or any of my other videos, please consider liking and subscribing to stay up to date on my account. I'm also interested in any feedback you have on my videos, whether it be quality, content, whatever. I'm new to YouTube and I want to create an entertaining product for you, so please leave a comment with any ideas or tips you have. Thanks for watching, good luck with your own trades, and I'll see you next time.